Right, so we'll just get started. Good evening, ladies, and thank you for joining us. My name is Sandra Robertson. I'm a financial advisor with Gilson Gray Financial Management, and I'm joined tonight by my colleague, who's also a financial advisor, Rebecca Baird. So this is our second session. Tonight, Becca and I will be talking to you about planning for retirement. So a time in your life when you want to stop work. We'll spend the next 30 to 40 minutes just running over the key points that I would suggest you want to consider, hopefully give you a bit of food for thought. We have received some questions already from our previous session, and we'll cover these off just at the end. So retirement may be a time when you want to stop work completely, or maybe just reduce your normal working hours and you want the ability to top up your income before you retire altogether. How much you save in pensions or other savings and investments can directly impact on what you can afford to do and what choices you'll have at that time in your life. So we'll have a look at some of the factors that specifically affect women, and we'll consider, for example, do you know how much you have in pensions? How much should you have? Do you know what you've already got, what it will give you in retirement? Do you have any sort of shortfall in terms of what you need or what you'd want? So lots and lots of questions. Having a second set of eyes on your financial future is always a good idea, and Rebecca and I are here to help. We can arrange to sit down with you after today and just have a good look at your individual circumstances. So today we'll give you that opportunity to have a think, and afterwards you may well want to sit down, have a coffee and a chat, and have a look at what are your goals. And we can help you to have a more of a structured plan. As I mentioned, there are certain issues that tend to affect women. The gender pay gap is often in the headlines. However, a lesser known problem is that we also need to address the gender pensions gap. It has taken a long time to address the gender pay gap, but with each year that passes, women are getting more financial parity with men. So the gender pay gap is shrinking, but the gap is not completely closed. So more younger women nowadays are starting their working lives earning nearer the same as men doing the same job. Now, women make up 48% of the UK workforce, so that's nearly half. Life expectancy for a woman is longer than a man. We are likely to live longer. Therefore, it would make absolute sense then that a woman would need a larger pension pot. However, by age 65, on average, women will retire with only around a fifth, 20% of the value of a man's pension fund. So in short, women are entering retirement with far fewer assets than a man. That might be pensions, it could be savings and investments. And those assets then need to stretch so much further as women expect to live longer. Also, imbalances in assets between men and women mean that, for example, a heterosexual couple, women are more likely to rely on their partner's income. So that then makes it all the more vital that as a couple, are you aware of the assets that your partner or husband has, so that you're able to plan your finances jointly? We can't ignore research that women are also disadvantaged due to the fact they often take a more caring role in the family and are likely to have taken time out of their working life. They may have taken maternity leave or a career break for a number of years to look after children. And it's more common, I would say, for a woman to be involved in looking after elderly parents. I have a number of friends now who are very involved in arranging carers and generally needing to be there for their parents as they become elderly and less able to look after themselves. So according to a recent Office of National Statistics survey, women account for 75% of part-time workers. Therefore, as an example, if the woman in a heterosexual couple earns less, she's the one that's more likely then to reduce her working hours for childcare or looking after elderly parents. But this then further reduces how much a woman can save in her own right towards retirement. So most people tend to save a percentage of their salary to a pension or towards retirement. But if you're earning less, You're likely to be saving less too. One thing not to forget though, even if you are on a career break and you're not earning, you are still eligible to pay money to a pension. You'll still receive 20% tax relief on your contributions. It is up to a certain limit. It's not as much as if you were working, but you can still contribute. So you can keep that stream of income going into a pension plan. So taking account of the higher number of women working on a part-time basis, having breaks to focus on family, it's clear why many women have to work harder to ensure they can enjoy a comfortable lifestyle, comfortable retirement, So we can see there are a number of causes for the imbalance between men and women, and these are driven by working patterns, but also the gender pay gap. The average pension wealth among 65 to 74-year-olds during 2018 was 260,000 for a man, and it was half for a woman, 130,000, and that's a big gap. The good news though, the good news is that the eventual gap in retirement wealth is expected to be smaller for younger people who are entering the workplace today. So the key really is the earlier you begin planning and saving for your retirement, the better. So by making your pension a priority early in your working life, and even if it's as much as paying a little bit extra, £50 or so per month, could make a big, big difference to your eventual retirement income. But if you find yourself, you're in the middle of your career or halfway through your working life, and you're really unsure if you have enough set aside for retirement, don't panic. A comfortable retirement is still within your grasp. You can still ensure that your plans can catch up with what you're dreaming to do. It might include doing things just a wee bit differently, but the thing is you need to have a goal. It's about saving smarter, about being informed and having a plan. So my job as your financial advisor is to help you to achieve this with a very clear and specific plan. I mean, there really is nothing more satisfying for me and as an advisor to sit with one of my clients, to plot out what you've got, what did you say you wanted, let's see where your gaps are, and to confidently say to someone, you can afford to retire early, or you said you wanted to retire at 62, you can do it. I mean, it's a brilliant feeling. So the sooner we start saving for retirement, the more choices that we have later in life. So when you think about retirement, what do you see? What do you picture? What does it look like for you? Whether it's initially reducing your working hours or stopping work altogether, you're going to have a lot more time on your hands, more free time. So how do you want to spend that time? I know for myself, I always find my weekends are the quickest 2 days of the week. Running around, trying to do all the things I've not had time to do during the week when I'm working. Never quite got enough time to just do nothing if that's what I want to do. When I think of retirement and how I want to spend my time, it's about spending time with your friends and family, but doing it at your leisure, taking your time to go for lunch, go for a long walk. Definitely, when I think of retirement, I want to travel. There are so many places that I'd love to go and visit, spending time, and not just 2 weeks in the summer or for a fortnight, to rent an apartment, maybe stay for a month or stay for 6 weeks, really explore and enjoy different countries and different places. I mean, how lovely would it be to think, maybe I could buy a property abroad, grab a cheap flight and just go anytime I fancy. That just sounds amazing. But how much would that cost? Can I afford it? So I know how I'd like to spend my time when I stop work. So how much income will I need? A Which magazine recently surveyed 7,000 retired couples, and their findings suggested that as a guide, a 2-person household to have a comfortable lifestyle would need an annual income of 26,000 between them. If you want a luxurious retirement, a couple would need 41,000. What I would say is it is very much an individual assessment of what is normal living for you. So if you are part of a couple, what pensions do you have? What does your spouse or partner have? When are they payable? Is it just an income? Do you get a lump sum? So again, lots of information that we need to establish. So if we're looking to put together a plan, where do we start? So my advice to you would be, dig out a recent bank statement. And I know we're not all living the way we normally do with lockdown and everything else. But if you look at a bank statement and ask yourself, if I retired yesterday, what's going to be different about how I spend my money? So at the moment, do you have a mortgage? Have you got young children? These are the two sort of biggest expenses most of us have at certain points in our life, but they will stop. So when will your mortgage be repaid? When do you plan to retire? Will the mortgage be paid off before that point? If that's the case and the mortgage will be paid off, take that out of your expenses. Any life insurance linked to the mortgage, any other insurances, they can be removed. Have you got children? What age are they? When do you anticipate they will be financially independent? Do you have after school care, clubs, school fees? Are your children at university? So you can actually look forward to say, at what point will they no longer be financially dependent? So if your children are through education, by the time you retire, we can then remove all these child-related costs as well. What about work-related expenses? Do you commute into work? Do you need a car lease? Do you spend a lot on fuel? Maybe you've got a train pass. Do you buy a coffee on the way into the station? Do you go out at lunchtime? What about work-related professional fees, memberships, these types of costs? So we can remove mortgage, children, work-related costs, and that would give you a good gauge as to your essential expenditure. So all your routine stuff, gas, electricity, council tax, food, mobile phones, all the things you need every month, that's your basics. So we work out your basics, but what about the good bits? What about your bucket list? What do you want to be doing in all that spare time you're going to be having? More holidays, longer holidays, out to lunch more, just generally socializing more. Maybe you want to join a gym or take up a hobby that you've not had time for, learn to play golf, join a golf club. These are all the extras that we would class as discretionary spending. The key thing to bear in mind, I would say to you, is that your expenditure will vary as you get older. Your regular essential costs will be fairly steady and constant, but your luxuries and extras are likely to reduce as you get older. I look after clients from all different walks of life, all different levels of wealth. And in my experience, when they get to kind of mid-70s to 80s, even though we're all fitter, living longer, much more mobile in this generation, they reach an age where they can't really be bothered. Can't be bothered taking 4 hours to get to Tenerife, or the hassle of going to the airport. I'm not going to bother changing my car because I'm not really doing any mileage. So your financial needs will change as you get older, and they're likely to reduce. And that's how I look to build a plan with any of my clients. We use cash flow modeling, so it's a computer software, and we can gather all the details of your individual circumstances and plot these in. So looking at different stages in your life to see, what do you need, what do you want, and what do you want to be able to do at different times in your life, because that will change. And that's the way we can confidently plan your retirement to ensure that you can enjoy that time in your life, safe in the knowledge you can afford to do the things you want to do. So once we know what you want and what you'd like to have, we need to then look at, so what have you already got? Do you know what you already have in place? We can work that out for you. We just need to look back and assess the gaps. We say, where's your target? What are we aiming for? What have you already got? So we assess, where's your gap? There's a whole range of assets you can use to fund for retirement. It's not necessarily just a pension. Each have its own pros and cons. Recent statistics showed that on average in the UK, people work with 6 different employers in their working life. So that would be 6 separate pension plans with its own set of rules. So even if you remained working with the same employer for a long number of years, you may well have seen a change in pension plans. Your employer may have merged with another company or been taken over, which has resulted in changes in your pensions. So that's a really common situation, but it's not a problem. It's something I deal with a lot on a day-to-day basis, looking to gather up all the details of all your pensions that may be scattered with various employers. It might be an option that we consolidate these all together and put them in one plan, and that allows us to then build for the future and look at the different pensions you have. We can then see what you've got, so we can then assess when can you retire, when are these pensions payable, what age, what is the value. And don't forget, of course, you will qualify for a state pension. So do you know what you're due from there? It's easy to check on a government website. So at the moment, it's just over £9,000 a year that's payable at state pension age. And that state pension age will be determined by your date of birth. So it could be 66, 7, 68 or later. So add that into the mix. It can make a significant increase to your overall pension income at that stage. So remember, all these different pensions that you've paid into are your money. So it is really important to keep an eye on what have you got, where is it invested, how is it invested, is it still making money? Because an old pension can lie there dormant for a long number of years. So you don't need to understand all the details of your existing pensions, because that's my job. I can do that for you, and then I can put you in a much more informed position. So I'm now going to pass over to Becca, and she is going to look at the different types of pensions that you may have.
Perfect, thanks, Sandra. As Sandra has mentioned a little bit, yeah, there's different types of pensions, and sometimes people can be quite overwhelmed or confused by the different types of pensions. So I've tried to break it down and make this as simple and straightforward as possible. The first one I think that's worth mentioning is the final salary pension. This can also be known as a defined benefit pension. What this one does is it pays a retirement income based on your salary and your length of service. The really good things about this type of pension, it's very secure, as it provides a guaranteed income for the rest of your life. As you can imagine, something like that is very, very valuable. And as a result, we're seeing these less and less prevalent final salary pensions. Generally, there are special workplace pensions that have been set up, and these are most often provided by the public sector or for government employees. So, and it is seen as one of the most generous pensions out there. There are some negatives or some things you need to consider with this type of pension. They're not very flexible. You can't vary the income that you receive or you draw, or receive lump sums other than your initial 25%. It does provide a pension to a spouse, but that can't be transferred to other beneficiaries. So there are some really positive points, but also some pitfalls or things you need to be aware of. The next type, which is probably the most common one that we would come across, that Sandra and I would talk to clients about, is what we call a money purchase pension. Again, also known as a defined contribution pension. It is what it says on the tin, this one. So the benefits payable are calculated based on the contributions paid into the scheme. That's generally made by yourself, the member, and often topped up by employers. And the amount that is in that pot is increased by the investment return achieved from that pension. These can either be workplace pensions or private pension. And the real luxury that you have with this type of pension is flexibility. So when it's looking to withdraw, or when it's that time when you're over age 55 and you may be looking at what your options are in regards to utilizing that money, you have lots of options available to you. Also, what you can do is have nominated beneficiaries. That doesn't need to be a spouse or a child. It can be anyone at all, generally, that you can pass this money on to. So it can also be something of a legacy. This generally is the most common type of pension, and the majority of people out there will have it. The other great thing about this one is you can generally be involved with the choice of investment that you choose based on your risk appetite. I mentioned briefly there about drawdown. So really what drawdown means is, as I say, when you turn age 55, you have the availability to utilize the money that you have paid into these pension or savings pots. The great thing about drawdown, like I'd already mentioned, is its flexibility. So for example, the majority of people are not going to be receiving a state pension until they're 60, 66 at the moment, but 67, 68. However, you can access money purchase or private pensions over the age of 55. So what that does is it bridges that gap during that period. It may mean allow you to go on a really nice holiday, or if you've got some larger expenses, which is most likely to happen early on in your retirement. So as I say, drawdown is connected to defined contribution pensions, and the options available to you at a very high level are you can access 25% of that fund tax-free. You also have flexibility in regards to the income that you receive. So this could be a regular allowance or occasional income as needed. Another option, which isn't often used, but it is an option, is taking the full pot as a lump sum, just being mindful that 75% of that would be taxed. Or the other option as well that sometimes people are not really considering is leaving the money to be invested and for it to grow over time. Again, if you don't need to utilize this money, it's a really fantastic way because this sits out with an estate for inheritance tax, and again, can leave a legacy to future generations. Annuities. Annuities is something that we don't speak of or hear of as much in recent years. But what this is this is generally purchased from an insurance company, and it provides a guaranteed income for life, like a regular salary would be. The annuity rate or income that you'll receive will depend on a numerous number of factors. So this can depend on the size of the pension that you've got, the benefits that you specifically choose, but most specifically your age and your health. Annuity rates are also linked to interest rates. And as we probably know and have been bombarded on the television and media over the last couple of years, our interest rates are very low. And as a result, the return that you would receive and the annuity rates are low. And when you do take that out, they're fixed. Therefore, they can't be altered for the future. So therefore, at the moment, as a general recommendation, annuities are not always the best option. However, there are some times that they may be an option for you. For example, if you are of impaired health, you may be entitled to an enhanced annuity, so therefore much more attractive annuity rates. So again, I think this would be something I would recommend that you discuss with an advisor if you were considering purchasing an annuity from the security aspect, or as I say, if you were in impaired health, to determine what options were available to you. Just as a side note, I would also say with annuities, I would recommend you probably disregard information from insurance companies in regards to projections, because that is really where they're encouraging for you to go. But just remember, there are a lot of other options out there for you, and that's not the only one. State pensions, Sandra's already mentioned already, but I think it's really worthwhile, and it's something that we often forget. This provides a regular payment, and it's made to you by the government, and that's paid once you reach state pension age. As I say, that is likely to be going up, 66, 67, 68. So there is going to be a period of time, generally from when you finish work until you become ready or entitled to reach that state pension age. So we need to consider that when we are building a plan for a potential client. And the amount that you receive in regards to your state pension depends on your national insurance contribution. So don't just assume that you're going to get the maximum amount. It's dependent on 30 years worth of full national insurance contributions. And something that I find with dealing with clients is they often think that they have achieved that. But especially for women, there's periods of time within their working career that they may have worked part-time or taken career breaks, bringing up children, for example. And as a result, there can often be gaps in this national insurance contribution, resulting in them not having the maximum amount, as Sandra had mentioned, which is about £179 per week, or just over £9,000 per year. So what I would recommend, in doing this sooner rather than later, because it'll allow you to top up any national insurance contributions that you are missing to be able to achieve that maximum pension. So yeah, you can, as I say, top up them and to make sure you're receiving the maximum, and that is an income that you receive for life. So really beneficial in this day and age where life expectancy is increasing and the advances in medical treatment, and we know that people are living longer. So that would just be a recommendation for me. Have a go on the government website and have a look to see what your entitlement is. Hopefully today will be the trigger for you to do that. Okay, back to you, Sandra.
Okay, thank you, Rebecca. So pensions usually form a large part of retirement planning, but it is a good idea to have a range of assets as you get older, because this does give you more flexibility, particularly, if you want to retire earlier, it gives you the flexibility to choose if you've got other monies to access. So for example, would you plan to downsize your home? Would you move to a smaller property that might release equity that could provide capital? Do you own any other properties? Would you be likely to inherit money by that time in your life that would give you capital that can be used for this? You may also have other savings and investments that you could use, for example, investment in ISAs. So that would give you tax-free income and capital. If you're a business owner, for example, many business owners have put everything into their business in the hope that it can be sold at some point to fund their retirement. And this may well be very much a viable option, but it is important to be realistic about how much is your business worth today and potential value in the future. With pension freedoms, which was a change in the pension rules, you can draw down income and capital from a fund, a pension fund, as and when you need it. My job would be to sit with you and evaluate and plan this for you so that we can ensure there's sufficient money in your various assets to last throughout the years when you need it most. So as Becca mentioned, a money purchase pension fund is investment based. Therefore, the value can obviously fluctuate depending how it's invested. So that's why it's really important to have an ongoing relationship with your financial advisor so you can regularly monitor how are your pensions growing? Are they working for you? So this is all part and parcel of the ongoing conversation that you and I would have if you were my client. My job would be to collate all your sources of retirement funding, savings, property, pensions, whatever it might be, ensure these are all working effectively for you, and to plan and adapt as you work towards and into retirement. So I hope that gives you a good overview of retirement planning, what to think about. Now going to move on to look at some of the specific questions that we were given previously. We'll run through answers to these and hopefully it'll provide you with some answers as well.
Okay, perfect. So the first question that came through, how do I know if I have enough to retire and am I going to run out of money? This question alone just proves how valuable it is to have an advisor who knows you. So because the answer to this question is it's very, very specific to every individual and there's no blanket answer. What I would do if you were looking for a starting point is to review, maybe sit down with a kind of recent bank statement and listing out your expenditure. Also think about, the essential need to have, and then the luxuries, those discretionary expenditures that Sandra was already talking about. So the nice lunches, the upgrade to the car, etc. That will give you an idea of how much you think right now that you are spending. Then I would project yourself into the future. That could be, say for myself, I'm in my mid-30s, that's a 20 plus years time. I would hope by then I wouldn't have a mortgage and there's some other aspects of my essential expenditure I would need to consider. However, if you're nearing that time, you may think, actually, I have a good understanding of what I will require in retirement. Something else that Sandra mentioned, which I think is really worth considering when answering this question, is that when you first retire, you're going to want to make the most of retirement, travel and experience life. And what we see is generally spending is much higher in the initial retirement phase. Whereas with age, as I say, you might not be bothered, your health might not allow you to be spending as much. So I would be considering that as your retirement progresses, you're maybe not going to be spending as much. So what we would do as a financial advisor, and what I would generally recommend for anyone to really answer this question and understand whether they're going to run out of money or not, is using some cash flow modeling programs. What this does is it allows us to build in things like inflation, which are very difficult to calculate on your own. And what it will do is it'll take into consideration all assets that you own, and working out where would be the best place to withdraw money at different times. And this will give you a very accurate insight into the future and tell you when your money is likely to run out and whether you have enough. So if that alone is not enough of a prompt to speak to a financial advisor, I don't know what is. So that's a really, really important one.
Okay, so looking at the second question, how much should I be putting into a pension? We did touch on this earlier when I spoke to you about, if you have a look at a recent bank statement as a guide, there's various calculators if you go onto websites for different companies, etc. As I mentioned before, it is very much individual, and it depends on your personal plans for retirement. I mean, how you normally spend money, what you want to be doing, how much income are you used to having. So quite often, if you look at, say, a final salary pension in days gone by, the maximum would have been half your final salary would have been the maximum pension you were allowed to get. So if you look at your salary now and say, if I was on half salary in retirement, what would that look like? I can help you to assess how you spend your money, because I would say people don't tend to change their spending habits. So if you like going out for lunch and you like shopping and you like spending money, you're not going to stop doing that or want to stop doing it when you reach retirement. But if you're in the habit of being very careful with your money and not overspending, I think it goes back to how you're brought up, to be honest. And I don't think it matters what age you are or how much money you have. Your approach to money will largely stay the same. So what I would do with you is gather all the information of your existing pensions to be able to calculate, looking at what you've already got, what age do you want to retire? I could tell you how much it would cost to bridge that gap. One thing I would say is all employers need to have pension schemes, so auto-enrollment rules. So have you looked at, in your workplace, if you were to pay extra to your workplace pension, will they match that contribution? So that's something that's worth investigating, just to see if there are ways of boosting your pension funds. And if your employer is going to pay some more, all the better. So most often, how much you pay in is really based on your budget. It's how much you can afford, because you may well have other commitments, other things to pay for. But it's really about building your retirement plans into an overall financial plan. So you have to look at everything that you have. There are a couple of pension limits you need to be aware of. So there's maximums annually that you're allowed to contribute and get tax relief. That's known as your annual allowance. And there's also a lifetime allowance. So that's about the capital value of all your pensions during a lifetime. But again, I can advise you on all these pension rules. So very much an individual assessment based on your individual needs.
Great. Next question is, I worked for a company for a number of years. I definitely paid into a pension. I don't have any information about it. How do I find out where that pension is and anything about that pension? First of all, what I'd say is if you paid into any pension at all, it's your money and it's your savings, so you're definitely entitled to it, and you're entitled to that information. Some pension providers and pension companies may make that quite tricky for you. But what I would recommend is, again, there's some really handy government websites, a Find My Pension. And ultimately, all you do is putting in your name, date of birth, and national insurance number. And that should be able to go out and search to see where pensions are with your details. I'd also say have a look through any documentation that you may have, whether it be paperwork or emails, for any correspondence and any kind of plan or account number. And if you know that the company name, it is about contacting them, with that plan or account number to try to obtain some information. And the whole process is about collating as much information as you possibly can. If you were to kind of come to a financial advisor like Sandra and I, we would obviously assist you with that, but with the plan number and the name of the company, we would get you to sign a document called a letter of authority and write off to that company on your behalf to obtain all of that information. I suppose just a side note on that one, if you are going to one of the government websites to find my pension, just make sure it's a non-charging one, because there are some other websites out there that may try to charge you, but you should be able to find out that information free of charge.
Okay, thank you. So the next question was, I've got a couple of pensions from a previous job, so how do I know what they will give me in retirement? Generally, you should still be receiving annual statements. A lot of pension information is now online, so you need to be mindful of, have you notified change of address, etc., so that they can keep in touch with you to make sure they keep you informed. If it's a final salary pension, your statement will tell you what income will you get in retirement and also the lump sum. If it's a money purchase pension, so from an insurance company, it will give you a fund value, but it will also give you a projected income on the assumption that you buy an annuity. So as we mentioned earlier, it is less common to buy an annuity unless you have impaired health. And generally, I wouldn't take a lot of notice of the annuity that's projected, because it does tend to be quite low. And at the moment, your priority is to accumulate money. So we're really just looking at the fund and saying we want that to grow so that we can then have that money available in retirement. So the level of annuity you would get at your retirement age could be quite different to what's being projected just now. Again, the key thing is, I would say, just take the time to sit down with myself or Rebecca, and we can assess all that and understand the information on your behalf. So we've got the office in North Berwick, so it's easy enough to just catch up with you and look over information for you. But the key thing I would say is make sure any previous employers have your up-to-date contact details so that you have all the information that you should be getting, because this is your money, even though it was through an employment previously, as money that belongs to you.
Pretty straightforward one here, and I think we've covered the majority of it, but is there a way of finding how much my state pension is? I mentioned it earlier, and I know Sandra's also mentioned it. It's about the best way and the quickest way is going onto the government website, and it's check your state pension forecast. If alternatively, if you don't like online, you can fill out a BR19 application form. Just probably will take a little bit longer, but it's the same kind of process. And what the information will come back is how much you're entitled to, when you can get it, and how to increase it, and if you can increase it. So they'll be able to talk you through that. What I would just say is sometimes people think it is a relatively straightforward process. You do have to create an account if you don't already have that with them. But then once you have that, you have login details and you can go back and check that. So what I would also say is just it is a great added benefit. We can't really rely solely on a state pension. That's why it is important to think about what additional assets we can top up. So yeah, I would generally recommend that you do that sooner rather than later.
Okay, so the last one, what happens to my pension if I die? That really depends on the type of pension. So if it's a final salary pension or public sector pension schemes, if you die, normally your spouse would be entitled to 50% of your pension income. However, if you were single, not in a relationship, the pension would cease on your death if you were retired. So you can't nominate anyone else other than your spouse or partner. So it's not payable to anybody else. Excuse me. If you have a money purchase pension, so example, through an insurance company, that fund, the value, the pension fund can be passed on to anyone on your death, and you need to nominate beneficiaries. So it's worth checking when you joined a pension, if it's a previous employer, for example, did you nominate anyone then? Would you want to change it? So if you've had a change in circumstances, if you've separated or divorced, make sure you've updated that information. The beneficiary can be changed at any time, so it's not set in stone. Money purchase pensions, you're no longer obliged to spend this money. So if as time goes by, your fund is continuing to grow, and even if you're accessing it, you might not be spending all the money. In the past, it used to be that you had to access a personal pension by age 75. That's no longer the case. So if you have money in a pension plan and you ultimately don't use it yourself, that can then be passed on to any person that you nominate. So it's passed on as an investment. So from an inheritance tax point of view, money in a personal pension doesn't form part of your estate. So it's a good way to leave a legacy for your family. You can pass on that wealth. So I hope that answers some of the questions you had. I hope you found tonight useful, giving you a bit of food for thought. But that brings us to the end of the webinar. So the key thing I would say is take control of your retirement and be able to plan to enjoy it. And we're here to help you. So after today, we will send you an email with a recording of tonight. It'll give you our contact details from myself and Rebecca. We're both more than happy to catch up with anyone. If you're needing to have a quick catch up, coffee, look at some initial information, happy to do that. We've all got busy lives. So I would encourage you to take the opportunity and start looking at mapping out your plan for stopping work. So thank you very much for your time, and good night.
Thank you.